What's up guys, it's Fred again. Welcome back to the channel and the hobby. In this video, I'm going to go through some of my top stocks right now, as well as what I think about the current market situation. And given the possibility that interest rates could actually go up a little bit, I'm going to run through several categories of stocks that I'm looking at between growth and value in the case that investors are actually going to rotate more from growth into value. Before we start though, I would really appreciate it if you just did me a quick favor by very gently smashing the like button for the YouTube algorithm, and you can also consider subscribing to my YouTube channel for more videos just like this one. So first up, for a little bit about the current economic and market climate, Fed Chair Jerome Powell just spoke for the second time in the last couple of weeks regarding inflation and interest rates. While a few weeks back when he first spoke, this actually sparked a sort of panic in the market, especially with tech stocks, because the public perceived his statement as the Fed not going to do anything about rising interest rates and inflation. And underlying this fear and uncertainty is the fact that US Treasury bond yields actually spiked rapidly to the highest level we've seen in about a year. Now, the effect of rising bond yields and thus interest rates is that people would more want to put their money into bonds as opposed to only in stocks, as they have done so for the past about a year. And that is because bonds are generally safer investments than stocks because they're pretty much guaranteed to give you that return, whereas stocks can definitely fluctuate, right?
Of course!
Plus, if interest rates end up going up, this would hurt growth stocks the most because they not only have to rely on investors for a lot of their cash flow because most of them are not yet profitable, plus it's going to make it more expensive for them to actually borrow money to be able to grow their companies. Plus, with borrowing being more expensive because of higher interest rates, that could even affect the demand of certain products such as, say, Teslas, that people will be less likely to borrow because of these higher interest rates, right? And coupled with the fact that hype growth stocks have generally been priced many years down the line with low interest rates in mind, this actually was the reason that we saw such a brutal and quick sell-off a couple of weeks ago. And that is one of the reasons that I decided to highlight a few more value-oriented plays in this video to help you diversify in case a broader rotation happens. But speaking of diversification, that's not to say that growth stocks are doomed, because also based on what Powell said both a couple of weeks ago and today, he basically said that inflation is only going to be temporary and that the economy is not going to recover that quickly. And he also said and reiterated that the Fed is not really going to do any sort of yield curve control, which again makes things a bit uncertain. Because bond yields are still relatively high right now, although Powell did say that they expect interest rates to stay really low, but in the case that it doesn't, I still think that the Fed will try to take action and do something about it. And because of that, I still am very much invested in many growth stocks and high growth stocks at that, but I am sort of diversifying my portfolio a little bit into more value-oriented plays. Speaking of which, another reason I've decided to invest in more value plays right now is the value versus growth leadership cycles. Essentially, in history, there have been cycles for years at a time usually where value either outperforms growth or growth outperforms value. For example, between about 1997 to the peak of the tech bubble, growth stock in orange definitely outperformed value significantly, right? But after the bubble popped, we had this really long, almost 10-year period where value did a lot better than growth stocks. And I believe this also correlated with interest rates, where lower interest rates supported growth stocks and a bit higher interest rates are better for value stocks. And if we look at the more recent trend from about 2008 all the way to actually right now, we've seen growth very much outperform value, especially in the past year. And we can currently see a very great divergence between growth and value, which actually has shrunk just a little bit after Powell's remarks, as well as the bond yields being a bit higher. So based on historical trends, and this is by no means guaranteed to happen by the way, but if we do see interest rates go up, we could actually see another several year cycle of where value again outperforms growth. And that was my take on the current market situation and why I'm investing the way I'm investing right now. By the way, a lot of this information I actually learned from George Gammon's video on the subject, which actually covers it in a lot more depth as well as with examples. So definitely go and check out his video, which I will link in the description box below if you're still interested in the topic. And with that, let's now get into the main stocks I've been buying or are watching closely right now.
It's showtime!
First, I want to talk about a couple of my favorite so-called growth stalwarts, which are still considered growth stocks but are actually a bit safer within that space because of how popular and profitable they already are. And thus many of the FANG stocks would actually fall under this category, such as the first one I want to discuss, which is Apple. I currently see the stock as having quite a bit of upside because it is still down from its all-time high, and I firmly believe that it is well positioned for the upcoming yet still developing trend that is 5G. As you can see, it is currently trading at roughly $125, give or take, with a forward PE ratio of 26.49, not the cheapest it's been, but if we look at its 52-week range, it is still a ways off from its $145 52-week high. Plus, analyst ratings on average have it at around $152 as well. And if we take a quick look at Apple's most recent earnings, not only did they do very well with their newest iPhone flagship sales, which is the iPhone 12, but they also beat across many different product categories, not just the iPhones, including for services, they were up 24% year over year. For other products, they were also up about 29% year over year, Mac revenue up 21% year over year, iPad revenue up 41% year over year, and with a gross margin of almost 40% versus 38% that was estimated. And just going over to some smartphone stats real quick, we'll see that between quarters 3 and 4 of 2020, iPhone market share actually went from 40% all the way to 65%, signifying that a lot of people actually did indeed switch over to an iPhone, most likely an iPhone 12, which is indeed a 5G device, which in my opinion likely means that a lot of people will stick with their iPhone 12s for a while for the 5G era. Not to mention, one of Apple's biggest strengths is its ability to create customer loyalty and thus retain users within its ecosystem. And despite the pandemic, Apple was actually able to deliver its largest quarter yet and is still growing at quite a rapid pace. However, one thing that could actually be weighing down on the stock price is the fact that Apple has not issued any sort of guidance since the beginning of the pandemic. And thus, with more uncertainty, investors are perhaps less willing to buy into the stock. However, I still consider Apple to be a decent buy at these levels, and I'll definitely add significantly, especially if it dips. And with that, getting onto our second stock, we have good old Facebook, which is a long-term investment of mine, and like Apple, is another FANG stock and a growth stalwart. Taking a quick look at its current price and stats, it is trading at around $274 with a forward PE ratio of 20 and a PEG ratio, which factors in growth, of 1.12, and these two stats together make it relatively cheap among the FANG stocks. And if we look at its 52-week range, it is a ways off from its $304 or almost $305 all-time high, which could represent that it has quite a bit of upside. Not to mention, the analyst price targets on average have it pegged at around $338. Now, in terms of its earnings, Facebook actually performed exceptionally well, having earned $3.88 per share, which is up 52% from a year ago and actually up 69 cents ahead of the consensus. Plus, its revenue surged 33% to $28.1 billion. Next, if we take a look at its monthly active users growth, we'll see that it is indeed still growing at a relatively steady pace, although perhaps not as much as of late in terms of a percentage basis. But what's more important perhaps is that in terms of monetizing their users, we'll see that in quarter 4 of 2020, they were actually able to monetize or earn rather $10.40 of revenue per user, which also has seen a lot of growth throughout the years. And then in terms of competition against other social media platforms and the like, according to research done by smartly.io, 50% of marketing teams actually spend half of their marketing budgets on social ads. And then of that 50%, within it, that is, 29% of marketers spend the majority of their ad dollars on Instagram, while 36% spend the majority on Facebook. And since Instagram is owned by Facebook, the two combined is actually, 65% within this 50% group that actually spends a lot on social media marketing. And then if we compare the various social media platforms in terms of what percentage of its users actually use it to follow brands and companies, Instagram actually sits at the very top at 36% of its users, with Facebook being 19%. But again, since Facebook owns both platforms, this is actually a very significant chunk of users across the globe. And meanwhile, Facebook has not only been gradually adding additional features such as shopping and also additional ways that they can actually monetize these platforms, but they're also improving the connectivity and synergy between their platforms. And down the road, Facebook is even considering taking a cut of profits from its Facebook shop sales, which could further increase their profit margins. And for yet another place that Facebook could actually see a ton of growth in the future, and perhaps hasn't yet really been priced into the stock price yet, we have the Oculus Rift business, including its ventures in AR and VR. As you can see from this chart, their sales of games on the Oculus Quest VR headset have actually spiked towards the end of 2020. And not only that, but I'm not sure how relevant this actually is, but I thought I would mention it anyway. But anyhow, Facebook actually got its first ever Oscar nomination for a documentary short, which actually involved heavily one of their teams from Oculus and their VR technologies. But regardless of whether Facebook achieves anything in the film industry, what's undeniable is that Facebook already has a relatively strong foothold and understanding in the VR technology space, which means that as this technology becomes more popularized in the future, which I believe it definitely will, Facebook will be very, very well positioned for it. Now, as for some risks that Facebook potentially has, first of all, it always has been under a bit of scrutiny in terms of antitrust issues as well as politics, but in fact, Facebook has already been constantly addressing those issues on their platform, and it hasn't really stopped them from growing so quickly, right? If anything, one thing to potentially watch out for is that Apple, of all companies, is actually considering a new privacy policy that could actually negatively impact Facebook's advertising on their devices. Moving on to our third stock here, and this time we have a almost pure value play that also has a bit of growth opportunity, as I will explain shortly. But anyway, it is Walmart, which is the largest US retailer, which also has quite a bit of international presence. It is already a cash generation machine with free cash flow of over 14 billion annually, and has a dividend payout ratio of 40% on top of being able to invest enough to actually grow its e-commerce business to the point that it's actually competitive. And taking a quick look at its stock price, it is currently trading at around $133, and with a forward P ratio of 22.73. And if we look at its 52-week range, it is also a bit underpriced from its all-time high, or 52-week range rather, which is also actually in fact its all-time high of $153. And then the analyst ratings on average have it at $159.8. And just to briefly recap its most recent earnings, its EPS stayed roughly the same as the same quarter of the last year, but revenue actually surpassed expectations and reached a record high. Plus, same-store sales growth was also higher than expectations, because that was very much driven by strong e-commerce sales as well as growth. Plus, late last year, Walmart actually launched a new subscription-based loyalty program to sort of compete with Amazon Prime, and this actually expands upon its already existing grocery delivery service, and actually really is driven strongly by not only brand loyalty but also its advantages in its grocery options. And if we dive deeper into Walmart's market share in the e-commerce space, we'll see that at least in early 2020, it was actually at second place with 5.3% market share, with Amazon being by far the largest player. No surprises there. But the trend to notice here is that Walmart not only was able to beat eBay for the first time in 2020, but also there's another trend that Amazon is sort of gradually losing a bit of market share between 2018 to 2020. And because of this, even though Walmart has been around for a while, I still like it because of its sort of growth opportunity with e-commerce and the fact that it's really investing a lot into it. And if we actually look at its stock price over the past couple of years, and again, despite being a more of a value and established company and play, we can see that the stock price has actually more than doubled within the last few years. And this is not even at its all-time high. And another great thing about Walmart stock is that even though it may not be the fastest growth stock, it is actually extremely safe in case something happens. For example, if we get the pandemic to come back, or the virus doesn't do as well as expected, etc. Because if we actually look to the past year when the pandemic actually started in March, whereas the S&P 500 actually crashed, obviously pretty hard, Walmart stock actually stabilized pretty well during that period, and I even saw around the same growth between April and May alongside the rest of the US stocks. So if you're looking for a relatively safe and stable stock to get into in case something bad happens and you actually need some money, you can pretty much cash out if the stock price doesn't actually drop too much, right? Walmart would actually be a great choice in my opinion, on top of the fact that it actually has a bit of growth prospect as well with its e-commerce branch. Not to mention, Walmart also pays out a modest dividend at 1.64%.
Look what I found in my pocket! Look! A year's salary right here!
Moving on to our next stock, we again have one that is between value and growth in my opinion, perhaps more leaning towards growth, and that is Qualcomm, which actually designs a lot of hardware and software solutions, most notably chips for a lot of cutting edge devices such as the 5G modem within the iPhone 12. I think this is a particularly exciting time for Qualcomm because of their heavy involvement in 5G, not to mention if Apple does well, which uses their components, Qualcomm will thus do well.
Nice. Nice! Nice.
And coming over to Qualcomm stats and stock price, first of all, it's currently trading at around $132 with a P ratio, a 4P ratio rather, of 16.27. And then its 52-week range indicates that its highest range was around $168, which in my opinion means it still has a bit of room to meet that. And then as for some of the analyst price targets, they are currently at around that level at $172.16. And again, I really like Qualcomm right now because of its heavy involvement in the 5G space. In fact, it was actually the largest 5G chipset vendor in Q3 2020, which actually powered 39% of all 5G phones sold worldwide, not just Apple iPhones. But just coming back over to Apple real quick, it is expected that they will continue using Qualcomm chips for their iPhones for the foreseeable future. And not only that, but Qualcomm is doing very well in several other areas as well, such as providing for a variety of phones like Samsung's, a lot of Chinese phones and the Asus phones, and also chips for audio devices. As you can see, they actually help and provide for a large variety of brands, and also even in the VR space. However, for a potential risk for the stock, they are seeing a shortage in some of the processor chips used in smartphones and gadgets and other things, which could actually sort of spread across different electronics if the shortage actually gets serious enough. However, in my opinion, this is sort of a shorter term problem that I don't foresee them having an issue with for the long run. And finally, for the last stock on this list, we have a bit of a bonus growth play, which has actually only recently IPO'd on the New York Stock Exchange. And because of this, I'm not currently buying it just yet, but I'm definitely keeping a very close eye on it on my watch list. The stock and company in question is Coupang, and despite its sort of funnyish name, and by the way, I think it began as more of a Groupon clone, but now it's more of an Amazon clone, and it's actually the largest e-commerce player in South Korea. And in my opinion, being an Amazon clone alone is already a very good thing that Coupang has going forward. For example, it actually has adopted something similar to Amazon Prime with a subscription service called the Rocket Wow membership, again with sort of funny names, but it actually is very impressive because it not only offers next day deliveries, but even same day delivery options. But get this, Coupang is definitely not all talk because first of all, with its impressive infrastructure that it's built out over the past years, it's got 25 million square feet of warehouse space that actually spans across 30 cities in South Korea, with 70% of the city's population within 7 miles of a fulfillment center. And not only that, but it also commands a whopping 15,000 full-time delivery drivers, which allows it to command such quick and consistent delivery, which is also similar to what JD.com has built over the years. And on top of that, they also own their very own grocery and food delivery service similar to DoorDash. And again, by being able to follow in the footsteps of already successful innovators like Amazon, JD.com, and DoorDash, Coupang really has its path already paved for them, which makes them a lot less risky in my opinion. Not to mention, South Korea is already such an advanced society that they are surely going to continue embracing e-commerce well into the future. Taking a quick look at its stock price though, it is currently at a bit of the expensive side right after the IPO with a price to sales ratio of roughly 7.65 rather. And so there is quite a lot of growth that is already priced into the stock. Plus, I'm probably going to wait until at least one earnings or two to be able to actually determine whether the price is justified. But with that being said, I'll definitely still keep a very close eye on the company and stock because of how much potentially I believe it has, and the fact that it may actually follow in the footsteps of the likes of, say, Jumia. Anyway, that is pretty much all I want to cover in today's video. Remember, you can pick up a free stock from Robinhood using the link below. Plus, if you actually smash the like button and subscribe to my channel, it really does help me out so much, so thank you. And with that, thank you so much for watching. I'll see you in the next video. Peace.